High income does not create wealth by itself. Wealth is created when cash flow is converted into retained capital. Retained capital is protected by liquidity, and liquidity is deployed into assets that can compound over time. That is why many high earners still end up broke. They have strong inflows, weak retention, poor positioning, and a lifestyle structure that turns income into pressure instead of ownership. You need to see the distinction clearly. Earning a lot of money is an input. Being financially strong is a system. The market does not reward you because you worked hard, stayed busy, or looked successful. It rewards capital that remains intact, gets allocated rationally, and survives long enough for compounding to matter. Your personal finances operate under the same rule. If most of your income leaks into fixed costs, status purchases, debt service, tax inefficiency, and reactive spending, you are not building wealth. You are renting the appearance of wealth at full price. That is the core problem high earners run into. They mistake income for security. They think the paycheck can outrun weak structure. It usually can, for a while. That is what makes the trap dangerous. A high earner can absorb bad decisions longer than a low earner, so the system looks fine, right up until it stops being fine. In markets, liquidity can hide fragility until conditions change. In households, a large salary can hide poor cash flow management until bonuses slow, clients disappear, equity compensation falls, or expenses rise faster than expected. Then the illusion breaks. You need to think about your financial life the way a disciplined investor thinks about a portfolio. In markets, prices move because of liquidity, rates, volatility, sentiment, and positioning. In your life, money moves for the same reasons in different language. Liquidity is your cash reserve and financial flexibility. Rates appear in the cost of your debt and the opportunity cost of not investing. Volatility shows up in variable income, job risk, business risk, or surprise expenses. Sentiment shows up in your spending impulses, social pressure, and your desire to keep pace with people around you. Positioning shows up in how much of your income is captured by obligations instead of assets. Once you see that, the problem becomes easier to diagnose. Most high earners are not poor because they earn too little. They are poorly positioned. That poor positioning usually starts with lifestyle inflation. Income rises, and spending rises immediately behind it. The nicer apartment becomes the larger home. The practical car becomes the prestige car. The simple travel becomes premium travel. The efficient routine becomes outsourced convenience everywhere. Then come the subscriptions, private memberships, dining habits, gifts, school costs, services, and upgrades that each look manageable on their own. This is where most people misread the system. They look at individual purchases and ask whether each one is affordable. That is the wrong question. You need to ask what the entire lifestyle does to retained cash flow, liquidity, and future ownership. A high earner who makes a large income but saves very little is financially weaker than a moderate earner with stable surplus, low fixed costs, and real assets. That sounds obvious when said directly, yet people ignore it because visible income is easy to admire and invisible discipline is easy to overlook. The market makes the same mistake during euphoric phases. It values stories, momentum, and surface numbers more than resilience. Then conditions change, and everyone remembers that quality of structure matters more than excitement. You also need to understand why high earners are especially vulnerable to the psychology of overextension. When your income is high, your confidence rises with it. You start to believe that future earnings will solve present mistakes. You assume next year's bonus will cover this year's excess. You assume your skills are portable, your industry is stable, your employer will keep paying, your clients will keep renewing, your business will keep growing. That is a dangerous assumption set. In finance, the problem is never just optimism. The problem is optimism attached to fixed obligations. Once your rent or mortgage, debt payments, tuition, and lifestyle costs are built around best-case income, even a small disruption becomes expensive. That is why high earners often end up living in a liquidity drought while appearing prosperous from the outside. They have good furniture, good watches, good restaurants, good vacations, a good address, a good car, and a weak balance sheet. They are asset light and obligation heavy. They have income, but not insulation. They have access, but not ownership. They have cash flow, but not retained capital. And once you are in that position, the margin for error shrinks quickly. So let's make this practical. If you are a high earner, your first job is to stop evaluating your finances through the lens of gross income. Your real indicator is retained capital after taxes, spending, debt service, and necessary reserves. That number tells the truth. If it is small relative to your income, you are not as strong as you look. If it is volatile, you are vulnerable. If it disappears when one variable changes, you are fragile. Start by calculating your true monthly burn rate. Not the ideal number, the real number. Include rent or mortgage, insurance, debt payments, subscriptions, travel, dining, family commitments, utilities, taxes not withheld, lifestyle services, school costs, vehicle expenses, and irregular spending averaged across the year. Then compare that to your reliable after-tax income, not your best month, not your peak quarter, and not the optimistic projection in your head. Many high earners shock themselves at this stage because they discover that their fixed and semi-fixed obligations have eaten the flexibility out of their lives. Once you know the number, you have to separate variable income from core income. If your compensation includes commissions, bonuses, stock grants, profit distributions, or irregular consulting revenue, you cannot spend all of it as though it were salary. That is one of the fastest routes to ending up broke on a high income. Base lifestyle should be supported by base income. Variable income should primarily serve three roles: building liquidity, buying assets, and accelerating debt reduction where appropriate. When people reverse that order and build permanent lifestyle around temporary peaks, they turn volatility into personal risk. If the market moves lower and financial assets become more attractive, you want free capital to act. If your industry weakens and income becomes less predictable, you want low burn and high liquidity. If rates stay high, you want optionality, not a lifestyle built on monthly obligations. That is how you should think. Your response to changing conditions should come from structure, not mood. If income spikes, you react by increasing retained capital first, not expanding lifestyle first. If income falls, you react by cutting variable spending immediately instead of pretending the dip is temporary. If markets become euphoric, you react by tightening discipline, not by spending more because paper wealth is up. The reason this matters is that most high earners never transition from earning power to capital power. They remain workers with expensive lives instead of owners with growing assets. Capital power means your assets begin to contribute meaningfully to your future. That only happens when savings are large enough, consistent enough, and protected enough to compound. A high income can help you get there faster, but only if you stop consuming most of the advantage. This is where most people stop, but this is the advanced level. The advanced level is understanding second-order effects. A higher income does not just let you buy more things, it changes your identity, your social circle, your expectations, and your tolerance for inefficiency. That means the danger is not just one bad purchase. The danger is a chain of commitments that alters the entire system. Buy the bigger house, and you do not just buy housing. You buy higher taxes, higher maintenance, higher furnishings, higher expectations, and often a need to keep earning at a high level indefinitely. Buy the luxury car, and you do not just buy a vehicle. You buy insurance, maintenance, replacement expectations, and a new identity standard. Move into a premium social environment, and generosity, travel, clothing, dining, and gifting all get repriced. This is how correlation breakdown happens in personal finance. At first, high income covers everything. Then rates rise, markets wobble, bonuses shrink, taxes bite harder, or family demands increase. Suddenly the large home, the car payments, the private commitments, and the weak liquidity position all start interacting. That is a personal liquidity trap. You look wealthy, but you cannot absorb a shock cleanly. You have to keep producing at a high level because your obligations are now structurally high. That is not freedom. That is leverage wearing a tailored suit. Bankruptcy mathematics at the household level is simpler than people think. The probability of failure rises when fixed costs grow, liquidity falls, debt service increases, and income visibility weakens. A high earner can stay above water for a long time while still moving toward fragility because the system has more cash flowing through it. But volume is not strength. If the outflow structure is wrong, the system is weak regardless of income. Many high earners do not collapse in one dramatic event. They erode slowly. They borrow against future earnings, sell investments at the wrong time, carry tax bills they did not plan for, and discover too late that their lifestyle had no margin built into it. There is also a behavioral trap that high earners almost always underestimate. Success in one domain gets misapplied to finance. You become good at law, medicine, sales, engineering, entrepreneurship, or entertainment, and then you assume that strong earning power implies strong investing power and strong spending judgment. It does not. Competence is not universally transferable. In fact, high performers are sometimes more vulnerable because they are used to being effective. They assume they can handle leverage, concentration, private deals, speculative bets, or complex tax decisions because they are generally capable people. That overconfidence can be expensive. That is why you need a written system. Not a vague intention to be better with money, a real operating framework. Decide your target liquidity reserve in months of spending. Decide the maximum fixed cost ratio your life is allowed to carry. Decide how bonuses, commissions, and windfalls are split between taxes, reserves, investment, and discretionary use. Decide the maximum percentage of net worth allowed in illiquid or speculative positions. Decide in advance how much lifestyle is allowed to rise when income increases. If you do not predefine the rules, your environment will define them for you. Now bring it back to day-to-day execution. The high earner who stays rich behaves differently from the high earner who ends up broke in a few specific ways. He treats income spikes as capital events, not spending events. He keeps fixed costs lower than his peers expect. He avoids financing image. He understands taxes before spending the money. He automates investment before lifestyle expansion. He knows the difference between a reward and a liability. He measures net worth growth, liquidity, and asset ownership, not just earnings. You need to audit your cash flow the same way a portfolio manager audits exposure. Look at the last 12 months and identify the drag. Which costs are fixed and essential? Which are fixed and ego-based? Which are variable but recurring? Which provide real utility? Which exist mainly because you got used to them? Then classify each by strategic value. Does it protect health, income capacity, or family stability? Does it save meaningful time that can be productively used? Does it directly build assets or reduce serious risk? Or does it mainly signal status, relieve stress temporarily, or maintain a version of yourself that the balance sheet has not actually earned? Once you see the pattern, create response rules. If a purchase raises fixed costs for years, it gets the highest level of scrutiny. If a purchase is justified by future income, it is delayed. If a purchase is mainly about signaling, it is downgraded in priority. If a purchase reduces investable capital materially, it must clear a higher bar. If a new line of spending appears more than twice in a quarter, it is treated as a developing habit, not a one-off. These are tactical rules, but they protect the whole system. To practice this skill, journal major purchases and income changes before acting on them. Write down the after-tax amount, the recurring obligations created, the opportunity cost in foregone investment, the impact on liquidity, and the time horizon. Then reverse test it. Ask what happens if your income falls 20%, if your bonus disappears, if markets sell off, if interest rates remain high, or if a tax bill lands at the wrong time. If the decision still works under stress, it may be sound. If it only works in a favorable environment, it is probably a disguised risk. You should also simulate pressure before real pressure arrives. Run a 2-month test where you live only on base salary and invest the rest. Run another test where you cap discretionary spending and see how much surplus appears. If you have equity compensation, simulate a large drawdown in that asset and ask whether your lifestyle still works. If your job has cyclical risk, simulate 6 months of reduced income and see what breaks first. These tests are not pessimism, they are diagnostics. Strong systems survive inspection. Maintain the skill with a review loop. Every month, track savings rate, retained capital, liquidity in months of expenses, fixed cost ratio, debt service burden, and percentage of income going to assets versus obligations. Every quarter, review whether spending has risen faster than net worth. Every year, compare lifestyle growth to investable asset growth. If lifestyle is winning, you are drifting toward fragility even if income is still strong. You should also combine this skill with other tools. Valuation matters because if you are finally retaining capital, you want to avoid overpaying for assets. Macroeconomics matters because rates, inflation, and labor market conditions affect both investments and personal risk. Technical analysis can help stage entries modestly so you do not force large sums into unstable moments. Risk management matters everywhere, in portfolio concentration, in career dependence, in debt, and in lifestyle design. The same logic governs all of it. Protect downside first so upside has time to matter. And under pressure, the test is very simple. If income drops, do you already know which expenses get cut first? If markets fall, do you have liquidity to continue investing? If a bonus hits, do you know exactly where it goes before it arrives? If a large purchase tempts you, do you have a rule that separates earned flexibility from emotional reward? Pressure does not create discipline. It reveals whether discipline was there. The reason high earners still end up broke is not mysterious. They confuse access to money with ownership of capital. They let rising income finance a rising identity instead of a rising asset base. They build visible success before invisible strength. And when conditions change, the structure that looked impressive turns out to be fragile. If you want to avoid that outcome, the order has to change. First, build surplus. Then, protect liquidity. Then, automate ownership. Then, let lifestyle rise, carefully and late. Income is the engine, but retained capital is the result that matters. And there is one detail in all of this that deserves a second look. Because it quietly controls almost every outcome, the speed at which your lifestyle responds to your income. Slow that down, and wealth has a chance to form. Let it move too fast, and even a high earner can spend years looking rich while getting nowhere.